The Monetary Policy Committee of the Central Bank of Nigeria has cut the interest rate by 50 basis points to 27%, while adjusting the cash reserve ratio and retaining other key parameters. As at the 302nd meeting, which also coincides with the CBN governor's second year in office, he highlighted gains in forex access, quicker compliant resolutions, and a stronger banking system. Uloma Oyimachi reports.
It's the CBN governor's fourth time this year addressing outcomes of the Monetary Policy Committee meetings. He says a unanimous decision of the MPC reduces the monetary policy rate by 50 basis points, now standing at 27%. Other key decisions include lowering the cash reserve ratio to 45% for commercial banks while retaining 16% for merchant banks. The asymmetric corridor has also been adjusted to plus and minus 250 basis points around the benchmark rate, while the liquidity ratio remains at 30%. The committee says the move is aimed at supporting and sustaining economic policies while consolidating the gains already recorded in disinflation, exchange rate stability, and external reserves.
It particularly noted the increased momentum of disinflation in August 2025, being the highest in the past 5 months. This deceleration, underpinned by monetary policy tightening, exchange rate stability, increased capital inflows, and surplus current account balance, have helped to broadly anchor inflation expectations.
Mr. Cardoso added that 14 banks have fully met recapitalization requirements, stressing that policy consistency is vital to strengthen the financial system. He lauded the record-breaking growth of the gross external reserves to $43.05 billion. But he warned that geopolitical tensions and trade uncertainties still pose risk in global output.
Global inflation is projected to sustain its deceleration, albeit at a slower pace due to the impact of trade tariffs and other structural challenges. This trajectory has necessitated a cautious and data-dependent approach to monetary policy easing by central banks, especially in emerging markets and developing economies.
The last MPC meeting for the year will hold November 24th and 25th, 2025. Uloma Oyimachi, TVC News, Abuja.
And so to help understand the fundamentals of this last CBN monetary policy meeting, I have with me the president of the Capital Market Academics of Nigeria, Professor Uche Nwaleke, who is joining me from our Abuja studio. Thank you so much, Professor, for joining us at this point.
Yeah, thank you for inviting me, Tolu. It's my pleasure.
All right, of course. Let's start with the big news now. The central bank recently cut the MPR by 50 basis points. What's your assessment of this move from a capital market perspective?
Okay, I think it's positive for the equities market in particular. We know that usually when you have lower interest rates, the investors, traders, portfolio managers would want to rebalance their holdings in favor of equities, because what that means is that by the time the interest rates begin to trickle down, you expect that bond yields will begin to fall, and of course equities become attractive. So it's going to be positive for the equities market, no doubt. I expect, of course, that happened. You recall the announcement happened about the time the market was closing yesterday. So I want to believe that, yes, the market actually has reacted, to it. But we expect to see further reactions, in the coming days.
So, given the MPC's decision to cut the MPR while retaining a tight CRR for commercial banks, would you say monetary policy is sending mixed signals to investors, especially in a market already grappling with liquidity distortions?
I think the signal is clear. The signal is quite unambiguous in the sense that the MPC not only cuts the monetary policy rate by 50 basis points, the MPC also reduced the cash reserve requirement to 45% from 50%. And when you also take that alongside the fact that the MPC adjusted the width of the corridor, okay, the standing facilities corridor around the MPR from what it used to be. It used to be +5 minus 1. That's plus 500 basis points minus 100 basis points. When I say 5 and 1, I'm referring to 5% and 1%. Okay, so it has adjusted that to plus 250. That's plus 2.5%, and minus 2.5%. That's minus 250 basis points. So, of course, what that means is that the banks are now in a position to borrow money from the central bank. Central bank, mind you, is a lender of last resort. Borrow money from the central bank at a cheaper rate than they used to do. Before yesterday, banks were borrowing from the central bank at 32.5%. That's talking about the monetary policy rate of 27.5 plus the corridor of +5 as 500 basis points. So that's 32.5. And so right now it has dropped to 27 plus 2.5, which is 29.5. So banks are now borrowing, cheaper. So all of that, of course, is meant to put more money in the system, and banks are expected to reciprocate by, of course, on lending, making funds more available to, particularly the private sector. So I think, yes, one might say it's a signal that they're doing. Signal in the sense that the rate cut is, quite small. 50 basis points is actually quite small. 27% MPR is still elevated, by all accounts. So, but that signal is important, particularly to the markets. What we now, tend to read, we now tend to see the future part of interest rates, in the near term and in the medium term. We expect interest rates to begin to, to come down. So I think the central bank MPC took a very right decision, and it's not surprising that all 12 members, were in agreement with the need to change policy stance from what has been a very hawkish stance of the central bank. And of course, the justification was provided in the communique that was released. The fact that we've had for 5 consecutive months, drop in inflation rate, which you may call a disinflation. And of note is even the one that happened in August, with stronger momentum. Inflation rate today has come in, in August came in at 20.12%. So the disinflation that was recorded, coupled with the stable exchange rates we've also witnessed in recent times, the fact that the central bank too now has more power to intervene in the forex market, external reserves, according as you heard from the CBN governor, okay, has grown to $43 billion. Okay, enough to finance over 8 months of imports. So with all of that, the central bank felt there was need to, begin to ease, policy somewhat.
All right, let's look at this adjustment. How does it align with the CBN's dual responsibility, or dual mandate rather, of price stability and economic growth?
Okay, well, interestingly, the Central Bank of Nigeria doesn't have a dual mandate, unlike what you have in some other economies. In the US, for example, the Federal Reserve has a dual mandate. The Federal Reserve is not only watching inflation, the Federal Reserve is also concerned about jobs, concerned about unemployment, which is also what I've been advocating, that for developing economies such as Nigeria, the CBN should be given a dual mandate of not just price stability, but also supporting output. But it's interesting to also note that in the statement by the central bank governor, part of the justification for even cutting the rates, he talked about efforts by the central bank to also support growth. But that in itself is not part of the function, mandate of the central bank.
Okay.
The CBN Act of 2007 is clear that it's just price stability, which is why the central bank, up to now, would appear to have tended to defend its to be concerned with its mandate of price stability. The hawkish stance we've had is clearly a product of that, that position. Okay, so the issue of price stability is, of course, at the core of what the central bank is doing, which is also why you notice the central bank MPC couldn't do any deep cuts. They just cut 50 basis points, that's 0.5% cut. All right. So they had to do that because, again, if you read that communique, the communique was clear that despite disinflation, despite stability in exchange rates, that they have also noticed that the banking sector is still awash with liquidity. So the central bank is also cautious that the banking system still has a lot of funds, at its disposal, and there will be need to approach the easing of monetary policy, in a very cautious manner. So that, to me, was why the central bank didn't, for example, the MPC didn't decide to do a cut that is far deeper than what it did. The Bank of Ghana only recently cut their policy rates by 300 basis points. That's the Bank of Ghana. That's by 3%. So that massive cut, and they have done that consistently. But in the case of Ghana, it's understandable because the inflationary pressure there has, eased considerably. Inflation rate in Ghana today is around 11%, and that's very close to the Bank of Ghana's, upper band of 10%. Here we have a band of between 6 and 9%. CBN governor says they are targeting single-digit interest rates, which, of course, would be having an eye on that 9%. But if you look at where we are at the moment, 20.12% is still a long, way, which, in my view, is also why the central bank is trying to be cautious. Remember, too, that when it comes to inflation challenge in the country, it's not just demand-driven. It's not just a case of demand pull inflation, if you like. There is also the supply side. There is also the cost push side, which is actually the responsibility of the fiscal side. But I'm happy to note that it would appear that a lot of, if you like, handshake is now happening between the fiscal and monetary authorities. I think they are talking to each other, and that's also why you now find the introduction, for the first time, the introduction of the special CRR, cash reserve requirement for non-TSA, public sector deposits. Okay, so the central bank recognizes, and I'm sure that's also the fiscal side is also concerned, finance minister is also concerned, that each time there is, FAC meeting, FAC allocation, and money goes to states, okay, that has a way of also contributing to the pressure we see in the forex market, and of course helping exchange rates to rise. So one way to deal with that is what the central bank has done, to say all public sector deposits that are not in the TSA, because if it's in the TSA, you can exert some form of control. If you are not in the TSA, what you have to drop with the central bank is as much as 75%. So that is meant to, if you like, penalize banks that would rely on that, and also discourage them from chasing public sector deposits and then pushing them more to look for private sector deposits and, of course, and lend more to the to the real sectors of the economy.
Okay, so let's talk about the Nigerian capital market. How are they likely, or how is it likely to respond to this shift in monetary policy, especially in terms of equity and bond market performance?
Yeah. I mentioned that in passing, earlier on. I said it's going to be positive for the equities market because when, as I said earlier on, you have the trending interest rates, when they begin to trend downwards, the natural thing to do, of course, if you are an investor, you would want to pull away from bonds. Okay, bonds pay you interest. So you now want to, if interest rates are dropping, your yields, your return on bond is dropping, you want to migrate to equities. So that is what is likely to happen. We have seen that before, okay? And anytime too the central bank begins to raise rates, you also find investors migrating back to pivoting to bonds and then fixed income securities, generally. So that is also going to happen now. I expect that with, especially if we see further rate cuts by November when the MPC meets, I expect that that should, turbocharge, if you like, the equity segment of the market.
All right. So let's talking about rates cuts. Do you think this could potentially worsen inflation rather by fueling demand?
Okay, no, it's not going to worsen inflation. Mind you, the central bank would appear to us have a handle now on at least the demand side of inflation. I told you there are two sides. You have the demand pull and, of course, you have the cost push. In terms of structural factors, in terms of issues to do with transports, challenges, of course, the central bank may have little or no control over that. If you look at the inflation figure released by the National Bureau of Statistics, four of the items stand out. Okay, you have food. Okay, food is accounting for about 48%. Then you have restaurants. Okay, then let me even use the August figure for example. The August number came in at 20.12%. Now, out of that 20.12%, go and check the figure released by the National Bureau of Statistics. Food, okay, was around 8%. 8-point-something%. Then you have restaurants, okay, which can also categorize as food, because restaurant, when you see restaurant, it simply refers to meal away from home. So if you add restaurant to food components, you have more than 10%, you have more than 50% of the total, okay. Then next is you have transport and then housing, okay. These are the pressure points, if you like, of inflation. Now, if you're having transport challenges, of course, there's little the central bank can do about it. It has to be the fiscal side that should fix it. The same thing with housing, even for food, particularly where the food issue is being driven or partly being caused by insecurity. Again, the issue of insecurity is also the fiscal side on the central bank side. So what the central bank can do, which is what it is doing, is to try to fix the demand side. Now, the good news is that we no longer hear that central bank is, central bank engages in ways and means. Okay, so what central bank tries to do now is to check liquidity in the system, and it is doing that successfully using the tools available to it. So I don't think the court can fuel further inflation. Rather, it will help to anchor inflation expectations and reduce it further, which is why the central bank things. If you go by that communique says that staff reports, in other words, referring to the staff of the central bank, what they have done, according to what they have done, their research and so on, okay, had shown that inflation rate is likely to continue this downward trend, for the rest of the year. So if we are likely to see this inflation up to year end, okay, then you can be very sure, you can bet that by November when they meet, they're also likely to effect another cut. So generally speaking, I want to believe that inflation rate will continue to trend downwards, particularly so when you have, when exchange rate is also, dropping. So if the Naira is appreciating, you should expect that to rub off positively on inflation because there's a pass-through of exchange rate to inflation. So we have lower exchange rates, for example, you have lower PMS price, we have lower imports of petroleum products, okay? All these factors are cumulatively, having positive impact on the general price level. So I think this trend is likely to continue at least in the near future. And when you have low exchange rates, you have low inflation, and then you have you're also beginning to see stronger GDP growth rates. Okay, then you can be sure that the economy is really stabilizing. But one thing I want to see, which is my advice to the central bank, is that yes, we are told again in that communique, or the central bank governor mentioned it, that 14 banks, have met the capitalization, the new capital requirements, and that our banks are stable in terms of financial sector indicators. Yes, I was analyzing the financials of some banks. Yes, I'm very happy to know that in terms of prudential ratios, a number of them, including Zenith Bank, have very good, prudential ratios. So against that backdrop, against the fact that banks too, we have a number of them now meeting that minimum requirement, I want the central bank to also roll out incentives, to ensure that banks are actually lending money to the real sectors.
All right.
Okay. There is usually the issue of when central bank cuts rates, MPC cuts rates, banks don't also, respond by reducing their retail rates, reducing their lending rates. That issue has always been there. And I'm saying that the central bank can use incentives to ensure that banks are actually lending, to the real sectors of the economy. Such incentives can also include, using differentiated cash reserve requirements for banks that are actually doing that, actually complying and lending to the real sectors of the economy.
All right, so there's the concern about the sustainability of this rate cut, given the fact that Nigeria is facing fiscal challenges and rising debt service obligations.
Yeah, absolutely. You're dead right on that. I talked about it. I said inflation drivers are not just monetary. Mm-hmm. You also have non-monetary factors. Okay, so the central bank can only deal with monetary factors. The non-monetary factors, of course, are those factors that are within the purview, within the remit of the fiscal authority. And that's the reason the two must continue to talk together. Yeah, a situation in which, for example, you have fiscal surprises, you have fiscal injections, okay, that go to undermine the efforts of the central bank. Of course, that won't help inflation. It's a situation in which the government, continues to borrow, okay, particularly when you borrow and you don't put into capital projects or productive uses. So borrowing is not bad. One continues to say that. But when we borrow, of course, we should ensure that all those borrowings are tied to projects, projects that are, self-liquidating. That's the only way you can also, check the, liquidity, in the system. And now we hear the 2025 budget, the capital components, will start, being implemented, I think this month of September. So what it means is that we're also going to witness some releases into the, into the economy. And it's important, therefore, for both the fiscal side and the monetary side to sit to ensure that such releases of, implementation of the capital component of the 2025 budget, again, does not, pose serious risk to liquidity levels, in the system, and of course exacerbate the inflationary pressure. But by and large, I see, inflation trading downwards, generally for the rest of 2025. Again, on the back of the harvest season is there. That will also help, the issue of food inflation, and then of course, the issues around what the central bank is doing, particularly with respect to, firming up the naira. I'm happy to note that central bank has sufficient reserves now, at least to defend when it needs to ensure that the exchange rate doesn't spike again.
President, Capital Market Academics of Nigeria, Professor Uche Nwaleke, thank you very much for talking to us. Of course, it's been quite interesting hearing your view on all of this. Thank you so much.
Thank you. Thank you. My pleasure. Thank you.
Well, still to come on the show.